G'day, everyone. Welcome to the Mackay Goodwin podcast. Today we have a treat and a couple of extra participants in today's podcast. Firstly, we have Dom Calabretta, our CEO, Mackay Goodwin. Welcome, Domenic.
Thanks, Marcus. Good to be here.
We have Katherine Hines, our lovely Katherine Hines, who has a lot of feedback and a lot to do with the SBR process. So thank you for being here, Katherine. And most importantly, we have Gary Busby from the Australian Taxation Office. Good morning, Gary.
Yes,
and
good morning.
Thank you for being here with us today.
Yes, happy to be here.
Thank you. Excellent. Look, today's, as I said, is just going to be a discussion, general discussion around the SBR process. And that's obviously something that you're heavily tied to, Gary, and involved in with the tax office.
Yes, that's right. Yeah. So I lead the teams that deal with, amongst other things, the small business restructuring process.
Right. Yeah. Excellent. And as I've just touched on, the SBR is what we're here to discuss, and it's a relatively new process, I guess, in the insolvency world. Took a while to kind of take off, I guess, and be adopted, but it seems to be something that is becoming more and more popular, and it is, I guess, in some ways, ever evolving. And when I'm referring to ever evolving, I'm suggesting circumstances, criteria, assessment, and the like. So, look, we've got some things that we probably want to discuss. So first things first, Gary, SBRs, we all know about the general criteria, high level anyway, being one being under $1 million, total debt needing to be there or thereabouts under $1 million. Your tax lodgements need to be up to date and lodged. Entitlements, including super and wages, need to be paid, or any of those entitlements that are due to be paid. And the criteria around the not having done an SBR within the past 7 years or a simplified liquidation. So that's all well and good. Everyone understands, I think, the general criteria in terms of being able to undertake an SBR from a company's perspective. But I mean, what we'd really like to understand is the ATO's perspective and vision with respect to assessing a plan or a proposal that is put forward, and what the ATO would like to see or generally sees is part of their assessment. From what we understand, some of the higher levels that we are seeing is compliance. So when the tax office or the ATO is looking at a plan, from what we see and what we understand is that compliance is possibly the most important thing in when you're actually conducting an assessment. Is that one area or one thing that you would like to look at? I mean, I know there is a number of things, but people are saying to me is that there's compliance and there's director owns. What is good compliance? What is bad compliance? If there's bad compliance, should we even opt for an SBR process at all?
Well, let me preface that answer with our general approach.
Sure, please.
So generally, we support a restructuring plan that provides a higher return to creditors within a reasonable period of time than will be achieved in a winding up.
Yeah.
And so long as there's no overriding public interest issues. So that means that we won't automatically vote for restructuring plans simply because it provides a higher return than a winding up.
Yes.
Where we have concerns that the company may be trying to obtain an unfair advantage over other businesses through the conduct and actions of the directors, we wouldn't support a plan on that basis. So turning to compliance, yes, compliance is one of the things that we do look at. I wouldn't say it's the main thing, but it's certainly an important area that we do look at.
Yes.
And when we talk about compliance, that is in terms of lodgements on time, regular payments. So if we see a situation where there is a history of late lodgements and where there is little or no payment over a prolonged period, then that will be a factor that we will weigh up when we assess the plan.
Right. Okay. Excellent. Yeah. Rightio. That's
It's an interesting point you noted about, not many people think about this, but the anti-competitive sort of nature of the SBR, is that providing this business an unfair advantage by going into an SBR versus, similar businesses that are paying their taxes? Is that actually consideration that the tax office takes? So it's a point that really practitioners don't really consider.
Look, it seems to be an area that's getting a little bit more airtime from some academics that I am aware of. Look, it's something that we look at when we look at a plan. We look at in terms of the company's tax affairs, but also in terms of the integrity of preserving the tax and superannuation system. So our focus is probably a little bit more narrowed than the general competitive area. So where we talk about the competitive, it's basically trying to gain an unfair advantage over other taxpayers that are doing the right thing.
And I guess with that as well, it would come across with the practitioner, right, in terms of how they explain the circumstances and how the debt actually arose. So, and when you see, I guess, situations where there's a one-off incident, for example, where, and I see a lot of it, particularly like in construction or whatnot, where, you have a small kind of contractor, contracts to a builder falls over, and that builder can't pay. They're dependent. That subby is dependent on the builder to receive the cash so he can meet his own liabilities. And in something like that, I guess it's something that falls outside their control. Yeah. And I think, in that instance, it's certainly up not only to the practitioner, but with the tax office as well to consider that. And I think that's where you're kind of heading with that, Gary.
I think you need to crash test the reasons. Directors give you reasons for failure. I think the practitioner needs to test those reasons and make sure they're valid rather than making up reasons just to get the unfair advantage.
And so, Katherine, are you seeing some of those things as well with some of the plans? I mean, you do a lot of SBRs here, and is that something as well that you're seeing?
Well, amongst that, I see a lot of personal health reasons or mental health reasons, and that's actually an interesting question. Do you guys kind of look at that and understand in a way that sometimes things are out of people's control? I've had some directors that have been sick or have had to go through chemotherapy or something like that, and obviously haven't been able to run their business. I don't know. It's a very subjective kind of way to do you guys consider that type of thing?
What do we call those? Socio conditions or circumstances?
Well, interesting. Look, just to be very technical, under the Corporations Act, illness is a defence to insolvent trading. Might be a consideration that should be taken.
Yeah.
Look, where that information is made available, that is something we will consider. Yeah. But the main focus, as I say, will be around the tax affairs of the company. Yeah. And trying to preserve that integrity of the tax system.
Yes.
So, we weigh up all the whole range of factors.
And Gary, with that as well, there's a lot of people like my accountant has told me not to lodge because I can't pay, and I'm just like you. I don't understand where you're going with this, because of course the tax office is going to be relatively concerned with the fact that A, you haven't been lodging, B, you haven't been paying, but there's absolutely no interaction. How does the tax office know that you're going through some circumstances or is in a position to work with you if you're just purely hiding and putting your head in the sand, right? So for me as well, I'm like, you need to lodge, you need to report so everyone can see actually what's happening. So then if and when you do actually have an issue, that it is much more fluid in terms of trying to get your point across. So, rightio, that's really interesting. And so let's say, for example, Gary, that there has been poor compliance, and I feel you may not see this, but I'm seeing that a lot of accountants are being tarnished by their clients saying, oh, my accountant didn't do it, my accountant didn't do this, my accountant did that. And then they're like, but we're back on board, and they may have moved from let's say they've gone quarterly. They were previously quarterly, and then they've changed to monthly reporting so that they can prove that they're back on board. And I'm like, well, look, at the end of the day, if you're going to sit there and part of your proposal or reasoning for the failure or for the poor compliance is your accountant, one would want to expect that you perhaps change those particular ways. So I guess where I'm getting to with this is that certainly if I was the tax office and I was someone making these accusations or reasons, you'd want to put some, proof in the pudding or something along those lines, where you want to back it up with proper actions to support what you're doing. You can't just say you're going to do that and then expect everyone to believe it.
Yeah, look, that's right. Look, good signs of compliance are people lodging and paying their activity statements on time and making sure that their superannuation contributions are paid on time. And in terms of where we're asked to look at an SBR plan where future contributions from cash flow are going to support the plan, then we would expect to see a cash flow forecast which clearly shows that the ongoing tax and super debts are being paid on time. But look, I mean, we always encourage early engagement, and look, it really is important for people to lodge their activity statements,
absolutely,
stuff on time. Look, if they have difficulty meeting payments, that's when that early engagement is also helpful, because we'll try and work with the client just to see if there is a solution that we can find that will help them. Yeah,
I mean, even with me as well, like, what else can the tax office do to try and encourage, compliance with lodgment history? I mean, that we now have the lockdown DPNs, right? If there is ever an incentive to lodge, it is to avoid from taking place.
I mean, with DPNs, it's an interesting one. We've had scenarios where directors and accountants don't even bother with an SBR because there has been a lockdown DPN. What's the ATO's position in negotiating an SBR and at the same time a DPN? Is that possible, where they approach the SBR but the DPN also needs to be rectified? Because a lot of people don't, head in the sand. There's a DPN out there. What's it matter? I'm not going to bother doing the SBR. I mean, what's the ATO's position in that?
I might just step back a bit there, just again to give a bit more background. So that if a company lodges its activity its PAYG and GST returns within 3 months of the due date, and a DPN is issued, then that DPN can be remitted on the appointment of a small business practitioner, providing that appointment takes place within 21 days of the service of the notice. If the PAYG and GST, net GST, is reported more than 3 months after the due date, it's already a lockdown, and that is a personal liability of the director. And any SGC that's reported at any time after it's due is again automatically locked down, and that can only be dealt with by or remitted in payment in full. So what it means is that where you have an approved restructuring plan, there will be monies that get paid, and there will be an allocation to some of that DPN debt. And that, because of the parallel liability, will also reduce the liability of the director. But any balance that's not met under that plan will still remain a debt of the director that he's personally liable for. Now, in terms of engagement, the director will need to engage separately in respect of that DPN liability, and not try and conflate it with the restructuring plan.
I mean, is it possible to do both at the same time? So, I'm doing an SBR, but, I'm putting my company director hat here, but here's my personal hat, and negotiate both at the same time. Because a lot of times they say, well, I'm not going to try to do an SBR because if I can't negotiate a personal, I'm back to square one.
But that's a big risk, because once that plan is signed and the report goes out, you can't change it. So they're banking on the tax office to actually accept both. Like, if it's like, no, we're not going to accept that.
So maybe they need to engage personally before the SBR and have an understanding where they sit with a DPN.
Can you do a payment plan on the personal lockdown DPN?
Yeah, look, it's possible to negotiate that. So long as they meet the criteria and its plan is acceptable. Look, I do understand that there is a bit of a crossover, because sometimes the only income the director has might be from the business. So there is a bit of
and that's a good point you raised there, Gary, because often people come and go, "I've got this lockdown DPN." right? What is this? And I said, well, that is, if the company, if for whatever reason, company can't pay or extinguish that liability in full, the tax office has the ability to come to you and say, right, well, you're personally liable. How are you going to pay for this, right? And so, and then once they say, they go, well, why would I even bother? And I'm like, well, but let's think about this. You let's say you're a RTO, a registered training organisation. Your license is attached to that ACN or the ABN, right? So if you just want to pack it all up, mate, it's not a situation where, you're not going to have an income anymore. You lose your livelihood. You need to address the company's obligation with respect to the tax debt, have that sorted with the tax office. And then once that's done, at least that machine can still run, and then you're in a better position to understand what you're going to have going forward. And then that's up to you to address with the tax office at a later date.
Look, I mean, full disclosure, when you're trying to negotiate the DPN is important. And, where there is some reliance on income from the company, then obviously that's something that should be disclosed.
Yeah.
And that will all be taken into account when considering, if a payment plan is appropriate.
Yes, of course. Yeah, well, I mean, if they don't have a business.
The chicken or the egg argument. Well,
yeah.
So, yeah.
Yeah, absolutely. Okay, yeah, that's interesting. We're seeing some situations, Gary, where I am anyway. I don't know about you guys, probably you as well, Katherine, to be fair. Where super's often an issue because people are like, okay, well, the SBR looks like a good process, so I want to address the debt. I want to get the best return possible back to creditors without having to pay, additional fees for a VA, for a voluntary administrator. But I've got this SGC DPN liability that I've received, but I've paid the super. I've paid it. Oh, well, you could not have paid the super. No. I said, did you pay it on time? Did you report it on time? Oh, I must have been a couple of months late, but I paid it directly to the super funds. Well, as soon as it's late, it has to be processed through the tax office for the SGC process, right? So they're like, well, I can't what do I do? And I said, well, first, you need to make sure that you actually did indeed pay them. Secondly, and correct me if I'm wrong here, you'd have to lodge an SGC statement to recognise that payment and perhaps any additional costs that is applicable to the SGC tax. But should that prevent someone from making an appointment? Because obviously at the time, and again, guys, jump in, correct me if I'm wrong, at the time of making the appointment, the superannuation, obviously it would be in the best interest if it's all paid and addressed. But certainly before a plan is proposed, that super needs to be squared away. How does one lodge that SGC statement? How long does the process take? Because I say if it's not addressed and it's not applied and you're not getting that, is it an LOP, late offset?
A late payment offset.
LPO, one or the other. Isn't processed in time. Regrettably, your plan is you just can't.
Look, I mean, what I would say is, get the superannuation guarantee statements in as soon as possible.
Yeah.
If there have been payments to the super funds, include that as a late payment offset, and that will come into the equation.
Yeah.
But yes, that will need to be processed at the ATO. So
is that something that the practitioner or the firm would need to process? I mean, it's obviously not something that we would be able to sign because it relates to circumstances pre-appointment, right? But would that be on our, when I say our portal, the SBR, the practitioner's portal? Would the individual or the director need to go?
We generally see that most of the SG statements are either submitted by a tax agent or the external accountants.
Right.
There is an Excel spreadsheet that can be used, and if that is used, it does allow the processing to be done a lot quicker. And the sooner that gets in, I mean, one of the things we do see is sometimes there's not a lot of, or doesn't appear to be a lot of liaison between that tax agent and the accountant, the director and the restructuring practitioner. The restructuring practitioner may have been told it's all done away, but it hasn't.
Agreed.
And it comes in late, and then you get those issues around close to the voting deadline, and there still seems to be an outstanding SGC.
Yeah, and then it's the ATO's problem. Yeah. Well, it's not the ATO's problem. You're warned about this.
Yeah, well, look, you're right. I mean, in terms of qualifying to appoint the practitioner, the $1 million threshold doesn't include those employee entitlements. No. But if there are due employee entitlements at that date of the appointment, they do need to have to be paid before the restructuring plan is sent out to the creditors.
If there's interest and penalties on the SGC, is that required to be paid in terms of eligibility, or is it just the principal?
You mean the Part 7 liability penalties?
Yeah. Look,
just the principal amount.
It's the SGC part itself. So that is the superannuation contribution, the nominal interest, and the admin fee. If there are additional things such as a Part 7, if it is a result of an audit, a Part 7 penalty, or in fact any GIC that might be on that, that doesn't have to be paid. That will still remain a liability of the company, but it doesn't need to be paid for the purposes of being able to submit that plan.
Yeah. That's interesting. So, correct me if I'm... okay, so is that, when they see these statements, is that broken down?
If you get like a running balance of it, you can see.
You can, okay. Rightio. Yeah, but in some of the VA scenarios and stuff like that, we see some proof of debts come through with SGC or super, and everyone's like, well, that's the full priority amount. I'm like, well, you better look into that, because it might not be, and it could be the difference of this company.
No. Look, it's probably worth pointing out that when we do submit a proof of debt in a liquidation or a VA, it's not, we don't submit them on the basis that it's a priority claim or a priority claim.
That's right.
It's just the tax debt.
That's right, yeah.
So you're right. The practitioner will then need to understand how much of that is the priority.
Yeah.
And there will be some adjustments to make for excluded employees, for example.
And I find as well is that the ATO is more than happy to assist with that breakdown and get that information, because, that can be the difference between, in a VA scenario anyway, accepting a proposal and getting a return to creditors or not,
What are some common red flags and reasons for rejection of a plan?
The most common, there's probably three that spring to mind. So the first one is really around non-payment of any director loan accounts or loan accounts with related entities. So we wouldn't support a restructuring plan where money's been borrowed from the company that hasn't been repaid and isn't being addressed under the terms of the plan itself. We would expect the plan to compensate for the loss of those funds.
Right.
So by addressing those, what do you mean? As in
repaying
the related entity? What about if there's been loans to related parties, but it's for the purpose of generating revenue for the company that's in SBR?
Look, it's still a debt owed to the company, and it's not always obvious that there's been a benefit to the company for doing that, but it is something we would expect to be addressed, because if the money is being loaned out at the same time the tax debt is accruing, then it means that money could have been used to pay down more of the tax debt, and that's the issue we have, that we expect the plan to address that gap.
Yeah. I mean, at the end of the day, it comes down to, if the director didn't loan himself that, or him or herself that money, the tax would have been paid.
But sometimes you might have needed to loan the money to generate more revenue.
Yeah, that's what I'm thinking.
I appreciate
Which I see that quite a lot.
But does that come back to the practitioner being able to explain that?
Yeah, explain, look, it was for commercial at arm's length reason rather than...
But see, Dom, this also comes down to like a Div 7A loan, right? You see Div 7A loans, and at the particular time when the Div 7A loan was taken out,
it was
right, and exactly, right,
exactly,
and there's a proper loan in place, and at that time it was making the profits would justify a Div 7A loan, right? But then all of a sudden the circumstances change, and they're no longer being able to either repay it. That's, for me, shouldn't be a fatal mistake. That's something outside of their control. But does that then that will have to come back to the practitioner explaining that and putting that forward, right? Everyone says Div 7A loans, Div 7. Oh, to show me it's a Div 7A loan. Where's your documentation? Where's the evidence? Yeah, is that
Well, look, I mean, those types of loans, as you say, they do work when the company is making money because it's a payment on account of a distribution that we made at the end of the financial year. But the problem does happen if the company starts to lose money and it's not able to pay that dividend. It's no longer there. It's sitting on the books as an asset. Yeah. All right. It's not been shown as a cost of the business in the profit and loss account. Yeah. So it's not been shown as part of payroll. So it doesn't have the on costs of super, payroll tax, workers' comp premiums and all that. So the director getting a very distorted view of the business, they might think actually the business is doing well, but it only looks like it's doing well because there's an asset sitting in the balance sheet, which they don't expect to pay. So that's when it all unravels, and that's when it becomes difficult. It's a bit like, I mean, if you were dealing with in a liquidation scenario, it's an asset of the company. You need to try and recover
absolutely
the best you can.
Yeah. So Gary, are you saying, well, just reading between the lines anyway, if there is a loan to a director, is that fatal? It's like, is there a criteria like tick, 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 tick? But if there's one of these like a loan, it can't be approved? Or does it come down to the explanation of the practitioner or the circumstances?
I think it's more about the loan itself is not necessarily fatal. It's how the plan is going to address that. So if the plan is saying, look, we do recognize there is a loan there, and, it was taken out at a time when the tax debt was starting to accrue. Yes. And, I can see how much tax accrued. I will be repaying at least that much.
Yes.
Into the plan. So
putting in the plan, like how they're going to address it, that's definitely something that you guys want to see.
Yeah.
Okay.
So if you can see the contribution into the plan is going to cover any shortfall that that's arisen as because of the unrecoverability of a loan, then that's how they should address it.
Yeah. So most of the time they probably can't pay it in full, right? So you just want to see some kind of contribution towards repaying it
in the circumstances.
And
the
what
best efforts.
Yeah. Exactly.
I think it will need to be pretty much close to paying it in full, depending on the amounts,
yeah.
right? If we're talking small amounts, and that's probably not that material, but if it's a material amount, and it would have made the difference between paying off the tax debt in full and not, then that's something we might take a much more closer look at.
Sure.
But that's why we always urge directors when they're putting the plan together, put forward the best plan possible in the circumstances.
Yeah, absolutely. Yeah. That's a common theme.
Because you only get that one.
You got one chance. Yeah. Oh, why can't I negotiate afterwards once it's out? Because that's not the law, mate. Yeah. Then they go, something's absolutely crazy. I'm like, mate, David Hurst, reasonable. He's come up with RSA, which is reasonable, sustainable, and achievable. So if you're going to say, I'm going to pay 100 cents a dollar over a period of 18 months, and you've got these forecasts in there, and one of the forecasts is that the company's going to win lotto, right? It's just like...
And with the help, obviously, the restructuring practitioner looking at the plan, look, if it's not feasible, then probably SBR is probably not the right solution for that business. That's right. But if there is scope, and there's that, and as I say, you talk about there is that one opportunity to do it. We do, where we are a major creditor, we are open to reviewing draft plans, so long as the information in the draft plan comes to us early enough so that we can turn that around for
the draft plan. Yeah, a big question that everyone's asking. Is the ATO still looking at the draft proposal amounts?
Yes, we are.
Within the 5 days, I think it is.
Yeah, look, there was a period over Christmas and New Year just gone where we had to pause reviewing draft plans. But since then, we've been back to normal reviewing draft plans where they get the information in on time. So, yes, we do, I say, no later than 5 clear business days before the plan is due to be sent out, because then it gives us a chance to actually analyse the material. And that also means that the information that we ask for in our standard opening letter that we send out is also provided, because that's the basis for our assessment.
Yeah, okay.
So if we can get it in time, yes, we will review it, feedback. And look, I will say that we, where we do get the stuff in on time and we are able to, we often end up in a situation where there's a plan that we find is acceptable.
Okay, right. And I guess just while we're on that particular topic as well, I mean, sometimes when we issue some plans out, sometimes we don't hear back from the tax office till like 4 p.m. or 3:50 of that particular day, which is fair enough. It's within the time frames. Sometimes there's because now there's reasoning, right, that comes with the decision. Right, and in some cases there may be an error, or from us interpreting that it was like, right, well, there was a director loan when in fact there wasn't a director loan. Is there any way that so a practitioner could call the tax office to say, hey, you might want to review this, or is there a way to? Because people come to us and they're like, is there a way for us to dispute this decision? And for me, I'm like, well, no, there isn't. Like, it's final. That's what it is. I don't know if you can comment on that or.
Look, creditors have the opportunity to change their vote at any time up until the vote closes. Yeah. So, and there have been occasions where we have changed our vote because we've had additional information come through. Yes. The challenge to that is to get the information in early enough. Yeah. Now, if we are, it's, within a few days, or in fact maybe 1 or 2 days of the appointment, we will always send out an information sheet to practitioners, and that's an information sheet that's evolved over a period of time, and it's quite comprehensive now. Yeah. But that does include a list of, and it's a standard list of information that we seek for each company. So the sooner that information gets in, the sooner we can assess it. Yeah. And then once the plan is in, we can issue the vote. But if we're still waiting for that information right up until the last few days, it gets so hard to do it, and because we might be waiting to give the company more chance to give us the information, they don't provide it in time.
Help us help you.
We then cast the vote, and there's no time to deal with any last minute information that might come in. So,
no, that's fair enough.
So look, they are tight time frames, but that's how the process was designed, and but as I say, our information is standard, so practitioners will know each time what it is we're looking for. Yeah. And the sooner the company can provide that to you, the better. And look, and it's designed around the same sort of information that we expect that restructuring practitioners would require themselves, just so that they can make their own reasonable inquiries for when they sign off their own declaration. Yes. So, and it's information that is usually available. There's not too much additional work that has to be done.
No, there shouldn't be. That's for sure.
Other than obviously a cash flow they may not have had in the past, they might have to put together. Mm-hmm. And there is some consideration around what the hypothetical return might be in a liquidation. Yeah. But generally speaking, most of the information is stuff that ought to be available. Fairly easy, and the sooner we get that, the sooner, and we get the plan, we can then assess it. And then if we do have queries around that, we do have time to go back, and so we will go back and we will engage. So if we need to clarify things, and then we do aim to get our votes out as soon as we can, if people aren't happy with the outcome, and that's always the case if we don't vote to support the plan, then, if they feel that we've misinterpreted something, or there's something else they could have given us, but they didn't, then if there is that time to get it in and for us to look at it, we will. But if there isn't, there's not much we can do. And as you say, once the voting deadline is closed, the votes can't be changed, and the outcome is what the outcome is.
Yeah, absolutely. Now I've got, just a question, and again, I'm not sure whether this is within your wheelhouse or not, Gary, but there's a wind-up application on foot. Regrettably, it's been escalated to that point where the tax officers had to actually go all the way, issue the stat demand, then go the additional cost with the application to wind up. The director has had more than enough time to consider the options. But nevertheless, they approach a practitioner and say, look, I really want to put forward an SBR. I could be in a better position now than I was 2 weeks ago to actually put one forward. A common misconception that I'm seeing from lawyers and accountants is, well, there's no point doing or appointing an SBR because the tax office is obviously aggrieved, which is fair enough, and upset, and they're not going to consider a proposal because they've been forced to go this far down the line in terms of recovering their debt. For me, I've seen a number of situations where there has been a wind up on foot, and a proposal's been put forward, which has been accepted. And I just want to clear that up, that again, so long as the plan is there, it's commercial, it's in the best interest of not only the tax office, the taxpayer, the integrity of the tax system, so long as that plan is there, that you're still willing to consider a proposal during that period.
Look, our approach to that situation, and it is actually mentioned in the information sheet that we send out now, is very similar to how we look at the same situation in a voluntary administration. Yes. So the timing of the appointment is quite critical there. So, if the appointment's made on the evening before the hearing the next day, then it's probably going to be something that we say, well, you haven't had time to put together a report, obviously, and we wouldn't consent to adjourning it, for example.
Yeah, well, you'd expect the practitioner to have.
But at the end of the day, it's the court's decision, right? So the court will make their decision based on what they have. So
yes.
If that's happening, then obviously the earlier they consult an insolvency practitioner, the better for them. So anything coming in at the 11th hour makes it more difficult.
Of course.
But again, it's the court's discretion.
Absolutely. And another question, just in that in mind, which department looks after the SBR once the wind-up application has commenced? So correct me if I'm wrong, but there's a SBR division, which I believe you're part of, and there's an insolvency division as well. Once the wind-up has been lodged or the application has been made, irrespective of the SBR being a practitioner being appointed, is it still handled by the insolvency team?
Look, there is a wind-up team that will deal with the winding up process.
Right.
But one of the things that we do, if we are aware that there is a winding up on foot, we liaise with that department and they liaise with us so that we are on the same page when it comes to dealing with the hearings.
Okay.
So that team, through a panel firm, will deal with the actual winding up application.
Sure.
But in the background, they will be speaking to us.
Yeah. And that's comforting to know as well, I guess, for everyone involved. Just because obviously the SBR team is what they do day in, day out. Does the tax office consider the social impacts? Is if, right, Mr. Director or Mrs. Director or Miss Director hasn't been compliant, may have been a little cheeky along the way, but you know what? We generally believe that they could make this work. And if we vote against it, there is the possibility it's going to go into liquidation. And then there's going to be a hell of a lot of redundancies made and obviously payouts, potential payout by FEG and the government. Is that something that is also part of the consideration process?
Well, as I mentioned earlier, look, our focus is on the tax affairs of the company and the integrity of the taxation system. So, yes, we are obviously aware of the FEG scheme and how that provides that safety net to employees that aren't paid if their employer goes into liquidation or bankruptcy. But that's not something that's necessary for us to consider when we assess the plan.
Sure. Okay.
And for the tax office, do you see it as it's been a successful, process from the beginning to now? In your point of view, is it something that, the tax office is welcoming as a part of the tax system, the SBR process?
I think we do. We do see it as a successful and filling a gap that there was in the market for the smaller businesses. Time will tell as to how long these businesses last post-plan, so we don't have any data on that at the moment. Right. So
I think last time you presented for us, some figures were released regarding the first 30 months of the SBR legislation. I've got them here. The figures were the ATO was accrediting 98% of restructuring. It was a majority crediting 90% of those restructures, SBRs, and it had a 92% approval rate of SBRs. They were great figures. Is that still the case?
Okay. Well, look, I don't have updated data for the whole of the subsequent period, but what I can tell you is from January of this year to the end of May this year, yes, the ATO was still a creditor in most SBRs, not everyone, but most. And we were the majority creditor, I think, in 96% of those.
Wow.
Yeah. In terms of our support rate for plans, that has been trending down. So originally it was very high in the early days, but it's trended down. I think the average for that 5 months to the end of May is 74%. So that's the level of plans that we've been supporting during that.
Is there a reason why it's trended down? Is it in terms of the quality of the plan?
It is partly in terms of quality of the plan, and I think it's also due to a more consistent assessment process from the ATO as well. So we've spent a lot of time, with our internal resources as to how we can make sure that we do apply the right settings for each of the plans, and we think it's a combination of the two of those things.
Oh, it's evolving, like we said as well.
Could be also, as the market becomes more aware, you've got the rogue directors wanting to take advantage of the system.
I mean, certainly the number of SBR appointments has been phenomenal this current year. I think last financial year it was just over 1,400. Well, I think the number of appointments to the end of May was 2,600 plus. So on track probably for about 3,000 for the financial year. So more than double last year. Look, the way we see it is it's a fairly straightforward process. Now people have sort of understand it and know how it works. It does, so long as the plan is fulfilled, it does provide a guaranteed return to unsecured creditors. And if you think the alternative is that these businesses either would have ended up in some form of liquidation or perhaps just been abandoned, and the likelihood of recovery there is going to be very much reduced. So I think in terms of serving the purpose of allowing the company to continue to trade, I think it seems to be working. And in terms of getting a better return for creditors, I think that seems to be working as well.
Well, as a taxpayer, and I don't expect you to comment on this, but as a taxpayer, I'd like to see a return to the tax office of a significant amount, and from what I've witnessed personally, I've seen most of the plans be successful. They are achievable, and they'd be much, there is no doubt in my mind, for a VA or for a liquidation, that you would be getting a worse outcome than you would in the SBR process, right? And that's not just coming down to the practitioner, let's say for a VA needing to trade the business, take on that risk, incur additional costs and fees, which will then kind of exhaust the available resources for the unsecureds, right? And another thing that I see is that SBR is just, it represents the majority. It represents an appointment that is more applicable to the majority of the small businesses out there. A VA is bang, you've got to do all these investigations, even if it doesn't matter if it's a one-man band or if it's a massive multinational.
Well, what's the stat? I think the stat is 75% of businesses are small businesses in Australia. So, there's, it's definitely providing a positive outcome, keeping jobs alive, keeping business alive, and providing the best return for creditors in that scenario. So,
and you know what it's also doing? And Gary, again, you may be seeing this from the other side with the tax lodgements and whatnot, but I'm finding now that the companies and the directors that have gone through the process are A, engaging more with their accountants, and B, are proactive with their lodgements. I'm genuinely seeing that. They're on top of it. You check in with them, how are you going, what's happening? Oh, I lodge this, I lodge that. So it's actually bringing out, it's educating, I guess, the companies, the directors as well through this process.
Yeah, I definitely think it's a positive outcome in what we've seen so far.
Practical.
Yeah. Maybe me is a final comment for practitioners. What can practitioners do better that you've seen, without mentioning names, in the whole SBR process?
A thing that's worth mentioning, I think, is that unlike a liquidator or voluntary administrator, a restructuring practitioner for the company doesn't become an authorised contact by virtue of their appointment for taxation purposes. So that means that we can't provide any information about the company's account until the public officer of the company actually appoints the practitioner or a member of their staff as an authorised contact.
I get so many calls for that.
And at last minute, and that's a great point. And I'm glad you raised that, because we're trying to converse with the tax. They can't talk to you.
Yeah, and look, and I think that's the first point we raised on our information sheet. But so yes, definitely urge that to happen early on. So, be aware of it. It's going to happen every single time. Try and there may be a bit of hand holding you have to do with the directors to get there, or maybe a tax agent as well if they're involved. They might be able to expedite it, but get authorized as soon as possible. Then you're able to verify what the tax situation is with lodgements. And the only other thing I'd say is, look, try and provide the information that we're looking for, our standard set of information, as early as possible.
Yeah, and that's fair enough. And I guess from I'm not, it's an excuse, but we try and obviously we chase up the accountant, the director, and we're like, guys, you're actually disadvantaged.
But I think we say the earlier the better, the higher the chance you're going to get an approval.
Yeah,
well,
but it's true, absolutely. And there is, like, we request information, we go through it, almost before it's appointed, right? Yeah. But that is not enough, guys. We need the true fabric behind it to actually try and reiterate or support whatever or obviously oppose the plan. Give us something, but don't come to us at the last minute and blame the tax office for not moving quick enough or coming back to us when you're the one that's been kind of dragging the chain. Yeah, all right. Well, thank you. Thanks for your time and some really sound points there. Mm-hmm. And we appreciate, you're a busy man. And thank you once again.
Okay, well, thank you for inviting me.
Thank you.
Good stuff.
Awesome.